Today, we're going to take a look at the current economic environment with respect to acquisition. It's changed so much over the last 3 to 5 years, and we've had to totally adapt to what this marketplace is really all about and how to get deals to the bottom line, how to get them closed. And today, I'm going to talk to you about how we've been reframing the future, how we repositioned ourselves to dominate the new acquisition economy. And I want to focus in on what does this really mean for you, because what we've done is to position you better to have a great deal of success out there. Acquisition has always been a team sport, meaning that it takes lots of different disciplines to totally put together a successful acquisition. There's legal, there's finance, there's accounting, there's negotiation, there's valuation, there's finding the deal. I mean, it goes on and on and on. There's so many things or aspects of it that have to get done. And each one requires a little bit of a different discipline. And the same person who's good at one may not be good at any of the others. So it's always been a very rough thing for one individual to put together from start to finish, unless they were really adept at bringing in all of the appropriate talents to support them. So today, what I'm going to do is show you how we've overcome this challenge. It's a major challenge, but we've overcome it really very, very well. And I think you'll see that here today. Here's what we hope you'll learn today: why and how the acquisition marketplace has changed. What still works for the solo buyer, because a lot of you still are going to want to do that and be that sole person out there looking to put your business together with little or none of your own cash. It can still be done. It's just a little bit harder than it used to was. Why NDFC repositioned for today's deals and how to leverage this evolution for your own success. So this is our view from 50,000 feet of what we're going to try to accomplish today and make sure that you leave here with takeaways that are beneficial to you in these areas. Let's talk a little bit about the shifting marketplace. Why is today different than a few years ago? Well, interest rates are higher. Sellers want continuity, not just cash. A lot of sellers really don't want to leave their companies. They wanted something that's going to continue on where they'll continue to be of value. Others, of course, do want to fully exit. But in any event, they're going to want a continuity solution, one where they get the majority of their cash up front, and then whatever the tail end of the deal looks like, they want it to have continuity and perhaps even certainty. And investors, the sources of capital, demand speed, safety, and strong returns, especially the safety and the strong returns. Investors and lenders really aren't into risk. They want to minimize that risk. And having minimized their risk, they really want a strong return. So it's kind of hard to answer both of those, but it can be done. And we're going to cover that today, how we do it. And there's this whole new adjunct to the market. It's called PE firms and family offices. And they're actively hunting in the lower middle market, which means that if you want to buy a company of any size, you've got some formidable competition out there. You got PE firms that have funds. They're well capitalized. They're going to outbid you. They're probably going to overpay for some of the companies they're buying. You have family offices that are sitting there on top of pools of their clients' money. And they've decided one of the ways to put that money to work very effectively is find a middle market company to acquire and put some of their family's money into that. So those are sources of competition that weren't really relevant to you, just going back 3 to 5 years. And the sad news is the old playbook is fading. And the reason for that, in a way, is solo searchers are getting boxed out of the middle market deals. And I just discussed with you part of the reasons that that's happening. And sellers are prioritizing to sell their businesses where they prioritize teams with infrastructure. In other words, they don't want to sell to a solo buyer because they're concerned that there won't be continuity of the purchase. Who knows what your resources really are and how deep is your capability of handling every aspect of the acquisition, including the post-acquisition of actually running the business. And that's especially important if they're going to carry back some paper on the deal. And even if they're not, they still want to know their company is going into a strong future. It's their legacy. They don't want to see it upset. And so if you don't have a strong team behind you with an already established infrastructure for getting the deal done, you're going to be at a very distinct disadvantage. You need more than hustle. You need an engine. And that's what we put together here at National Diversified. We refer to it as PIBA Gold, where PIBA, P-I-B-A, is an acronym for Partners in Business Acquisition. And under that banner, we put together an incredible engine to handle all of the needs of the current acquisition marketplace. There are essentially two paths today to business ownership. One is the small company model or the solo model, the solo entrepreneur. And for this entrepreneur, the market is still pretty robust, where the revenues are under $1 million and the EBITDAs are under 350,000. So in today's world, you're talking about some pretty small businesses. They may have 3 to 5 employees. The owner everything is in their head. When you buy the company, you bought a job because the owner works there and he's not working on the business, he's working in the business. And you're going to replace him, step into his income. And that's a great start. For a lot of people, that's not a bad point of entry. But that's where the small company model has evolved to. You're going to have to deal a lot with seller financing as well as your own personal capital. Now, your own personal capital can come from you, from savings, from family, from friends, from relatives, but you're going to have some capital somewhere. And you're going to have an aggressive seller financing offer where the seller's going to carry probably the majority of the purchase price. And training and effort create a possibility. So Bazaar Financing is a wonderful training ground for this type of entry into the marketplace. But it does start to break down in today's environment when you get into the bigger companies because of the reasons I've just been explaining to you. What still works, i.e. for the solo acquisitions, they're lifestyle businesses. They have that potential. They're good first deal or learning platforms. And Bazaar Financing tools and hustle will get you there. And you can have a relatively lean bank account. And if you follow all the rules and guidelines in Bazaar Financing, you can still get a deal done. But if you want to gravitate into those bigger companies, this is not going to be enough. There are certain limitations with this model for scale, exit value, and professional management. Those aren't going to be there. The exit values are going to be hard to build and hard to scale to. And getting to a place where you have professional management is a building process. And maybe if you put 2 or 3 of these very tiny companies together and you do hustle your butt off, you can maybe get to where you have a decent sized company over a couple of years. So I'm not demeaning the past methods that we've used. They still work. They're just harder and they're a little less productive than they've been in the past, but they work and they'll get you there. The bigger model, the modern model, which we refer to as pivot goal, partners in business acquisition. You're now looking at revenues of 25 million with EBITDAs of 5 million plus. So now you're going after something that has the ability to create generational wealth for you. And the capital stack is going to be very different than the smaller company. It's going to be a lot of lender debt. There's going to be rollover equity that the seller is going to take part of his equity. You're not going to buy the whole company. You're going to buy, let's say, 60 or 70% of it. The part that they still own, they're going to roll over their equity into your buying company. So part of the buying capital is their own capital in this form of this rollover. You're going to have mezz lenders in the process. You're going to have secured debt in some of these. You're going to have some unsecured debt. You're going to have some equity that maybe comes from you, family, friends. But the point is you're going to have equity. And the beauty of what we do, we've created some incredible ways of creating equity that didn't exist before we structured the deal. That isn't our equity, but it looks like it is. And it works wonderfully to get everybody else who's part of the capital stack in line. Another part of this is proven management and big enough to excite lenders. See, in the little deal, it's really hard to get a loan because the lender can't make enough money on the loan because it's so small. And, even though they're charging you probably a higher rate of interest than they do on bigger loans, they still can't make any money on the deal for all the effort and residual work that they have to put into the maintenance of that loan on books. And so they're not excited about it. They can't make any money on it. So they're not even motivated to get it done. The only person motivated at the deal table is you. And that's not the way you want it. You want to get everybody excited. So the beauty of these bigger companies is they already have proven management, which should excite you because you don't have to go grunt away day to day in running the business. You're free to work on the business instead of in the business. And your lenders are going to be excited because you're doing a $10, $15 million loan. They can make money on that loan and they can get very excited about dealing with you. And the other part of this modern model is a full NDFC DLT. And this is how we address the fact that one person, the person who's I'm trying to think of the old phrase, the something that ends with master of none. In other words, you do a little bit of everything, but you're not a master of any of them. Well, that doesn't work anymore. It just doesn't. The deals have become too sophisticated, even down to tax planning. Because if you make a mistake on any of these parts, the costs could literally eat up your profit. And you need the top experts in every aspect of what it takes to do these things. And in this bigger model that we use in Pivot Goals, you literally step into ownership of a fully supported company because we're your partner after the deal closes. So we have a vested interest in making sure this company runs well. And because it came with proven management, we're going to run day-to-day operations. You already have a successful management team in there. And then with the support of the infrastructure that we put together, as you'll see in a moment, how we structured the company so that it's designed for success. And we'll tell you again how we did that. But you step into ownership of a fully supported company. We're your partner. We're going to make sure it's operated well. You got a great management team, or we wouldn't have bought the company. So everything's designed for success.